Hi, friends. Today I'll discuss a significant event that has recently caught the attention of both the financial community as well as the general public. The case of Asmita Patel, a well known financial influencer, or Finfluencer in short, who was recently banned by the Securities and Exchange Board of India, or SEBI, for conducting illegal trading activities. The case has shed light on the growing concern over unregulated financial advice on social media platforms and its impact on the retail investors. Today, we'll go through the details of Asmita Patel's rise as a financial influencer, the accusations leveled against her, the legal actions taken by the SEBI, and the broader implications for the financial industry. I'll also share insights on how we can safeguard ourselves from falling into such traps and how we, as responsible investors, should approach the evolving world of the online trading education. So, let's discuss the rise of Asmita Patel. So, Asmita Patel was not always a household name. She started her career working as a vice president at JP Morgan, a leading global financial services company. During her time at the company, Asmita Patel had a decent salary as well as a stable career. However, she chose to leave the corporate world and venture into stock market space, eventually becoming a full-time trader. She began her journey as a financial influencer by sharing stock market insights on social media platforms like YouTube, Instagram, Facebook, and Telegram. Over the years, she built a massive online following with nearly 4 lakh subscribers on YouTube, 2 lakhs on Instagram, and around 80k followers on other platforms like LinkedIn, Twitter, or X, etc. She became known as the she wolf of the stock market and the options queen. Her rise to fame was no coincidence. Patel's content was engaging. Her success in the stock market seemed real, and her teaching methodology resonated with thousands of people looking to break into stock market trading. Her online presence also skyrocketed, and soon she was selling stock trading courses, claiming that her methods would help anyone, including housewives, become profitable traders. So let's come to the allegations leveled against Asmita Patel. So Asmita's popularity came at a cost. SEBI, the regulatory body that oversees securities and financial markets in India, began to notice certain irregularities. The accusations against Asmita Patel and her organizations were serious. Patel and her team, under the name of Asmita Patel Global School of Trading, or APGST, were found to be offering stock trading tips, education, and advice without the required licenses and registration. While education in stock trading itself is not illegal, the issue arose from the way she was providing these services. Patel promoted unregistered financial advice and tips, offering premium services to students without adhering to the regulations set forth by the SEBI. She used to charge exorbitant fees for her courses, which ranged from thousands to even lakhs of rupees. In one case, a single course was even priced at nearly 8 lakh rupees including GST. Moreover, Patel made highly questionable claims on her official website about managing enormous portfolios, stating that her team managed funds worth over 140 crores of rupees. Now, these claims obviously turned out to be misleading, and it became evident that she was trying to present herself as a market expert with credentials that were obviously not legitimate. So, let's come to SEBI's investigation. SEBI's investigation began after a significant number of complaints from investors who had participated in Patel's courses. More than 40 individuals filed complaints, raising concerns about the practices being followed by the Patel's organization and the losses that these individuals had incurred. Through its investigation, SEBI uncovered that Patel and her associates were involved in offering tips on stock market trading without necessary registration or authorization. This violation is a breach of the Securities and Exchange Board of India Act of 1992. SEBI's finding revealed that Patel's organization collected over 53 crore rupees from investors, much of which was done through illegal means. As a result, the SEBI board imposed a penalty of 53 crore rupees on Patel and her entities, which will be deposited in a special account as part of the ongoing investigation. Additionally, SEBI banned Patel and her associates from the stock market and trading activities. They were prohibited from dealing in securities and from offering any kind of stock market related services until further notice. Now let's talk about the most significant aspect of this case, which is the impact on investors. Many of the individuals who joined Patel's courses were ordinary people, students, housewives, and retail investors looking to improve their financial futures. They were promised big returns on their investments, and in many cases were even encouraged to borrow money from friends, family, or even take loans to fund their trading accounts. Some were even told to liquidate their mutual funds or sell their assets to pay for these high priced courses. Moreover, after paying these hefty fees, these investors didn't receive the promised returns. In fact, many of them suffered significant financial losses due to the poor advice they received. This situation highlights the dangers of trusting unregulated online platforms, especially when the individuals behind them do not have proper licenses to operate in the financial sector. This case is a stark reminder that while social media platforms can provide valuable information and insights, they can also become breeding grounds for fraudulent practices. We must be cautious about who we trust, and we should always verify the credentials of anyone offering financial advice. Now let's come to the broader implications. So the case of Asmita Patel has broader implications for the financial industry, especially in the context of financial education. While there are legitimate and accredited financial educators, this case highlights how quickly individuals with absolutely no formal credentials can manipulate the system for their own gain. Social media has democratized information, and while this is a positive development in many ways, it has also made it easier for the bad actors to exploit unsuspecting individuals. This is the reason why we need stronger regulations around the financial education and advice. It is crucial to ensure that individuals providing such services are properly vetted and also licensed by the appropriate regulatory bodies such as SEBI in India. Moreover, investors must exercise due diligence before making any financial decisions or investments based on the online advice. It is important to always ask the right questions. Who is giving this advice? What are their qualifications? Are they licensed? What track record do they have? These are essential factors to consider before committing your hard-earned money to anyone offering investment opportunities. So now coming to conclusion, the case of Asmita Patel serves as a cautionary tale for all of us. It underscores the importance of following the law and maintaining transparency when offering financial advice. While it's easy to be swayed by the promises of quick wealth and fast profits, the reality is that the stock market requires discipline, proper education, and also sound decision making. As investors, it is our responsibility to remain vigilant, to educate ourselves through legitimate means, and to avoid falling for scams that may seem too good to be true. Always remember that when it comes to your financial well being, there are no shortcuts. Thank you for your time, and I hope this video has provided valuable insights into the importance of responsible investing and also financial education.